Hi, everybody. My name is Jackson Pineau. I am your Director of Public Affairs, and I am going to be sharing with you our residential market update for October. So, this is clearly a presentation about September and what happened in September uh, in the housing market here in the Twin Cities. We're going to go over four major sections. It's pretty similar to what you guys have seen before from me. A few updates have happened just to make sure we're keeping things fresh here. We have, of course, the monthly housing charts. People are always eager to see those. We are going to condense them down. Normally, we go all the way back 2 decades. We're trying something out here. If you guys like it, let me know. We're going to keep to the most recent 7 years, so 2017 to 2024. Gives you that recent perspective, and we're able to see things in a little bit more detail. But those monthly charts are still there for you, okay? We're going to dive into some market segmentation with InfoSparks as our primary tool of how we find that information out. And then we're going to take a look at the wider economy. And of course, if you have any questions, feel free to put them in the chat. Or if you're watching this on YouTube, put them in the comments. And we'll get to those questions at the end of the presentation. If I do happen to see them and they fit with what we're talking about, I might pop them in early. All right, let's hop into that September housing market update that you're all so eager to see. Starting things off with closed sales. We ended the month of September with about 3,700 homes that closed. That's 11% down from September of last year. And with most of these charts, we're going to be looking at the month we're talking about, September, and each previous year. So 2023 September, 2022 September, and so on, right? That year over year percentage change is what you're seeing at the top above the absolute number. And you can see, like I said, we're 11% down from September of last year at 4,200. And we're about 16% down from 2022 at just about 5,000. Yes, there was a peak in September of 2020 at 6,700. And that is what we've been saying all along is that COVID peak, that run on inflation, even as we were getting into the final month of the third quarter of 2020, we were still seeing abnormally high closings. Prior to that, 5,000. 5,000 to 5,500 is what we were seeing in a typical September from 2017 through 2019, right? We have rebounded. That rebound effect has happened. We can bring in a little pen here for you, kind of a flat line, right? If we were to extend that down, we went up and now we went down. We'll come back in time, right? That's the important thing to focus on. All right, let's hop into pending sales, a good predictor of what might happen because the vast majority of all pending sales for September will be closed sales for October, right? And a little bit of a silver lining here. Remember, this is the first month of quarter four, and what do we see? We see a point and a half up from 36,000 of 2023. We're seeing 3,700 homes, 3,700 homes that were under pending contract in September likely become those closed sales in October. Yes, again, it is down from what we were seeing in 2020 and also down from that. Let's give it the equilibrium of the pre-pandemic economy, right? This is that same correction effect that we will be returning to time and time again for the next couple of years, right? Let's flip the script here and talk about new listings, right? We had a general increase in new listings prior to the pandemic, peaking in 2020 for September at almost 8,000, and then we've been dropping off and a little bit of rebound. Now in 2024, just under 6,000 homes were listed in September. That's 4% up from 5,700 in 2023. And I want to add in a new piece to this regular conversation that we talk about because you guys have seen slides like this before, and there are some questions that always are asked after the fact that I want to make sure that I'm answering now for you. So I'm going to be breaking down this portion of the slides into key takeaways for you all. For what we just talked about, sales and listings, we're going to break it down from what my take is on what your buyers and sellers could be expecting. And my hope is that if you see what my perspective is on what buyers and sellers should be looking at, you can pass that knowledge on to your clients and it will help you make better decisions for your own business, right? Let's add that direct value to you and your clients with these slides here, right? So sales and listings. From the buyer's perspective, sellers are still listing, as we saw in the previous slide, right? They're still listing, but even if it's less than what we saw pre-pandemic or during the pandemic, right? There's less competition now, as we saw in pending and closed sales. That has been a declining metric for the past few years. But look to the near future, right? We just saw that in pending sales, or sorry, pending sales that were marginally up. And that's likely to lead to marginally up closed sales in October, right? Not a guarantee, but it is an expectation now. From the seller's perspective, yes, there are fewer buyers out there than what was there in the past. You have fewer people out there looking to buy your home, and that's going to have some implications as what we'll see in the charts ahead. And there is a marginal outlook in October, like we mentioned, but let's keep in mind context setting here. We're starting to get into the fourth quarter of the year, and that final quarter is usually slower. There is a Q4 lull, and you might know that. I might know that, but your client might not necessarily know that, particularly if they're eager to sell, right? So keep that in mind, set those expectations appropriately. So that way they aren't coming at you saying, like, oh, hey, this economy isn't good right now. Well, yeah, you're also trying to sell a home in the fourth quarter of a year, right? Setting those expectations appropriately is important. Let's shift over and take a look at September's median sales price, right? $380,000 was the median sales price of homes sold in the Twin Cities overall. That is up 2.5% from 371,000 of last year. And I know some of you are looking at that and say, Jackson, 2.5% up. That's not where we were, 5, 6 years ago when we were regularly increasing, let's say, on average, 6-ish%, right? I agree with you. It's that same sort of correction phase that we were seeing with the blue bars, right? Because there was an astronomically, maybe that's a bit of an exaggeration, a significantly higher increase in median sales price from 2020 to 2021, double digits here in September. That normally happens maybe in May, right? But not in September. The correction that you're seeing here is a less steep slope in that red line that I've crudely drawn for you, right? Another way to look at that is year over year change in median sales price itself, just the change. In this chart, we were looking at the absolute value, how many dollars, right? Here, we're just looking at the change in that median sales price. And you can see more clearly how dramatic that change happened. In the first blue section, all the way off to the left here, this is those pre-pandemic numbers, and you can see I've parsed out a few here. Yeah, there was a high of 12 in 2017 because of the congressional tax changes that happened in 2017. But a pretty standard, let's say 6 to 7%. Yes, a 9% high, but around 5 to 6% around 2018 to 2019. We had a reaction of no activity or less activity or a lot of compromise for a couple months at the start of the pandemic, but then a new standard was set in this green area, which is The area that I would say is run-on inflation, peaking at almost 17% year over year increase in median sales price, right? And then the start of this right blue section, that's when the Federal Reserve starts to implement their higher savings rate. And that means there's less money to go around in the economy. People are less likely to spend money on high capital purchases like homes, right? They did a fairly good job. There was only 2 months, really 1 month marked here in red, down 1.3%. There was one that was kind of marginally down 0.1% just before it, but we're rebounding. We're now back in that world of 2.5 to 5%, and we will be returning to this in the long run. Now, let's talk about a different part of price is negotiation, right? Negotiation prior to the pandemic, we were at about 98% of all homes that were listed closed at 98% of what they were originally listed at, right? And then in COVID and throughout, we had an increase. People were getting 100 and then 1.1% over asking price at the median, mind you, not even at the average. Half of all homes were getting more than what they originally asked for. We're seeing a regression from that back to a more negotiation forward type of conversation between the buyer and the seller. Ever since 2020, at least for September's, we were seeing, under 100% of original list price received. In 2024, that was 98 and a half. That's down almost a full percent from September of last year. That was about 99 and some change. Another important factor to bring in here is the speed of that market, right? I remember hearing a lot of people tell me, Jackson, wow, the speed of how quickly homes sell is almost something that I can't keep up with. And that was realtors who were really happy with it, right? I'm sure some of you experienced the same thing. It's because we dropped from having half of all homes leave the market, go at least under pending contract, from 22, 23 days pre-pandemic to 15 and then 12 again in September. 12 days on market and then gone for half of our inventory in September of 2021. We're rebounding. We're now back up above 20 for September of this year. We're up, let's say 23 and a half, 24% from 17 last year. We are increasing, and this is a more sensitive metric than some of those other ones like price. Price doesn't change that much, right? It's pretty resilient. But the speed of the market, how quickly people make those decisions, that's up to the buyers, how quickly they want to jump on a property, right? So, what are the takeaways for prices and pace that I want to make sure you're aware of so that way you can pass that along to your clients? From the buyer's perspective, a slower market means more time to make the right decision. You don't have to necessarily jump as soon as possible because otherwise someone else is going to jump on that property. Now, take that with a grain of salt. It's all relative, right? But you do have marginally more time to make that right decision. Work with your realtor to make that right decision, right? So price growth has slowed, yes, but how long? We saw that decrease in that red dotted line. It's not as steep as it was prior to the pandemic, but we will return to that at some point. Make sure that you're aware that price growth will return. And that is a sense of motivation for your buyers. And, a positive thing here for buyers, negotiations are back. Now, on the seller's side, starting at the bottom just because I love a good ellipses joke. Negotiations are back. I will say for the baby boomers and older Gen Xers out there, I don't know if you've ever gotten this reaction from some younger people in your family. Ellipses are terrifying. They're terrifying to millennials and Gen Z because they see it as, ugh. But we'll use that now, right? Because it's funny. I like it. Anyway, negotiations are back. Ugh. For the sellers. Now, keep in mind, yeah, it might take longer for you to sell your home if you are a seller. Home prices are growing, yes. And here's the sunny side of it. They're past that major risk of negative price growth. You know, that one small little red bar that we saw dip down, that was the 1 month that we had at the median negative price growth. That was a risk. We thought it was going to happen for longer. It didn't. We're past that point of risk. And that's a positive to take from the change that we needed to make globally to put a pause on inflation. All right, one more subsection of this, and then we'll talk a little bit more about market segmentation. Let's talk about inventory, okay? Now, inventory is going to be the one area here where I do want to show you the historical context because it is important, right? We're still looking at the past 7 years as we have all along, and you can see there is a shift. Looks like it was two shelves, right? Let's bring our drawing tool back. We have a shelf, pre-pandemic and post-pandemic. I'm so bad at drawing a straight line with a mouse. I apologize. Um, but you have a shelf that we have kind of fallen off of since the beginning of the pandemic. Inventory used to be at 13,000 homes that were left on the MLS active at the end of any of these given Septembers, right? And we have dropped noticeably, and we are not returning back up from that, at least not yet. There's marginal return from, let's say, the bottom of about 9,000 in September of 2021 to now we have 10,000 homes left on the market in our inventory in September of 2024. That's 9% up from last year, sure, but it's not that steady return that we were seeing in any of the other metrics, right? This is the reason why I want to bring in the historical perspective of the full 20 years that we're used to looking at, right? It's because the red line that I drew was an arbitrary one, right? It wasn't just a bad one, it was an arbitrary one because that is what we were seeing here in 2017, 2018, 2019, right? But there's a better reference point to center off of here, and that's this red dotted line. This is what I would argue, and research shows, is what should be considered that true balance of what our inventory should be at to have an equal number, roughly, of buyers to sellers. If you're above that line, it's a buyer's market. There are more homes than there are people to purchase them. If you're below that line, it's a seller's market. And we've been in a seller's market for the past decade or more. Another way to view this is month supply of inventory. We're just taking the ratio of demand to inventory and we're giving it a number. How many months would we be able to survive if no new homes were left on the market, given the amount of demand we have in that given month? 6 months supply of inventory is a standard. We're starting to move closer to 5, so I've kind of roughly marked 5 out here as that red dotted line. And you can see, again, we've been in a seller's market for a while. Zooming back into that 7 year period that we've been looking at, you can see the variation in a smaller scale, right? But when we zoom back out, it's not nearly as dramatic as what we were seeing in 2007, 2009, down to 2012, right? So yes, there has been some change in the month's supply of inventory, i.e., the relative demand and how much inventory is left on the market. But given the inventory hasn't changed and month supply of inventory has, there are two factors: homes that are left on the market and how many people are out there buying those homes. If this line's flat, then this one must mean that demand is going down because month supply of inventory is going up. It's like an inverse relationship, right? So, inventory takeaways for your buyers. It's still a strong seller's market, ellipses, right? On the seller side, hey, it's still a strong seller's market, right? Uh, Back to the buyers, inventory is going up because of less competition, that decrease in demand, not because there are more homes left on the inventory at the end of a given month. And again, another just setting context for your sellers. Yeah, your home might take longer to sell. And that's an expectation, particularly as we get into the winter, that they need to be prepared for. So I know you all are eager for this sort of data, and we only have these presentations once a month. So I do want to encourage you to take advantage of our market data webpage, whether that be the tiles that you see here, info sparks, local market updates, our sortable statistics, or more. It's all available on our homepage. And then market data page up there at the top, right? Uh, on our MAR website, right? Let's dive into some market segmentation. If you do have any questions about the previous slides that I did show you, I'm happy to take a look over here and see if you have any questions. If not, I am going to keep going ahead and we're going to talk about some pretty critical segments of the market that I know people are regularly interested in, but with a bit of a twist. Because normally, again, looking at the past 7 years, we show you these bar charts and they are helpful because it's data pulled straight from the MLS. It's the raw data that I throw in Excel and make sure that it's a clean visual for you all, right? But you all have access to InfoSparks. So I'm going to be using InfoSparks a little bit more here to show you information that you can glean from topics like these when you don't readily have access to me and these charts, right? So let's take a look at beds, 4+ bedrooms to be precise, right? To take a look at the share first in any of these bar charts, and then any of the tools on InfoSparks, I'll walk through you how I made those charts, right? So the share of 4+ bedrooms here in the Twin Cities of all sales in September is up. We're at oh, I do apologize. This is year trends, not just September. So 2017, 18, so on to 23. That's the full calendar year. 2024 is where we're at right now. And it looks like we are up to a pretty high share of bedrooms, 4+ bedrooms being sold at around, let's say, 42%, 41, 42% of all closed sales so far this year, which is noticeably higher than what we were seeing in previous years, right? And we have this kind of this shifting effect, a sharp increase, a decrease, and then a return, right? And I want to show you a different way to visualize that on a regular basis, looking at InfoSparks. Now, you guys don't get access to the share of all sales through InfoSparks, but another way to view that is what's hot, how much demand is there? And a great way to indicate how hot a particular product is how quickly it goes off the market. So we're looking at median days on market by bedroom here. We got blue is 2 bedrooms, red is 3 bedrooms, and green is 4 bedrooms or more. The same stat we were looking at in the bar chart. And you can see a similar story here. It's just flipped, right? Prior to the pandemic, it took longer for those larger units to sell, right? We were seeing it as the highest one at, let's say, 28 days on market at the median, and then it dove down in the beginning of COVID. We believe that that was because people had more money to throw around and they wanted that extra bedroom, maybe for a remote office, maybe because they were expanding their family. Whatever the reason, they felt the desire to have larger homes. And now we're seeing a return. That the speed of that four-bedroom home at the median was below two and three bedroom homes for about a year, right? And then it slowly starts creeping back up to being, air quotes, less of a hot housing market for that particular segment of large homes. We're now seeing it dabble with the two-bedroom homes as a, slower or that middle child of the speed of the market divided by these three segments, right? And in time, I would suspect that it's going to return back to being a slower, not probably as slow as it was, but the slowest of the three in terms of how quickly homes this size will sell overall. Let's shift and take a look at the townhouse condo market share. And again, we were seeing townhouse condo market share be pretty stable. In the long run, we see a change anywhere between 30 to 20, percent of the market share, but it has been changing marginally for the past couple of years, right? Pre-COVID, 26%, let's say, down to 23% in 2020 because, like we were just saying, condos and townhouses normally aren't four-bedroom homes, right? And people wanted more space. But as interest rates increased again, then we started seeing an uptick. And by 2023, we saw a 7-year high of 27% of all homes sold in the Twin Cities were townhouses or condos. So far in 2024, it looks like it's about there as well. 26-ish percent of all homes sold so far in 2024 have been in the townhome condo market. Seen a different way to show you how uh, InfoSparks can give you even more insight. It may not necessarily be all townhomes and condos equally, right? This is why it's so important to know the neighborhood, know how your client's property fits into the narrative that I'm showing you from a 20,000 foot level, right? Because the average percent of original price, that idea of negotiation, right? Around homes broken out by single family in blue, condo in red, and townhouses in green, you can see there's a differing story. There's a negotiation process, like what we talked about earlier, that clearly happened with single family market here in blue. You know, just a little reminder, our equilibrium here pre-COVID, and then all of a sudden people were getting, at the average here in this metric, 2% over asking price, and then it dropped back down, right? But look, townhomes follow that as well, not condos. Condos, there's a different negotiating strategy, right? I can't tell you why because quantitative metrics don't give you an exact answer as to why. I can give you some ideas, you know. Condos usually take longer to sell, so negotiation isn't as strong at that point for the seller. But the buyer is willing to jump on an opportunity of a home that has been, sitting on the market for 90 plus days, you know? Uh, the condo market looks like they're more willing to negotiate. And a better understanding of this is they have been throughout the pandemic and afterwards. The expectations around negotiation in the condo market is down, like all of them are, but it's not coming from a huge high of competition like townhomes and single families were. Interesting, right? That's nuggets of information you can pull yourself from InfoSparks. Okay, one more example, and it's a kind of a journey, and I'm excited to show it to you. It's around new construction. Okay. So to give you the coverage here, new construction, market share, annual data, as always here, right? We were hitting in COVID a market share relative high of 36%, let's say, for 3 years solid, year over year. 36% of all homes closed in a given year were new construction. That's up from what we were seeing pre-pandemic, high 20s, right? But it is a noticeable increase. So far in COVID or post-COVID, and let's be more accurate in saying post full impact of the uh, Federal Reserve's addressing of inflation, because that's really the factor here, right? We are seeing a noticeable decrease, lower than what we've seen for the past 7 years. There's something interesting going on here. So let's dive in to InfoSparks to better understand this. I'm going to go live with you all with these charts, okay? So first thing I looked at was month supply of inventory, right? Because I want to have an understanding of that relationship between the balance of new construction inventory versus the demand for that inventory, right? Uh, and you can see here in the condo market in particular. Oh, was this the condo market and not new construction? Oh, it is. It's just new construction and it's in the condo market. What's going on here by those subtypes, right? We're only looking at new construction, and there's something unique happening with newly constructed condos that isn't happening to the same scale as single family and townhomes, right? That spike. Look, 25 months supply of inventory, that's a buyer's market like I haven't seen in a while. What's happening, right? My first guess is demand, right? Because as we were talking about, all month supply of inventory is a relationship between demand and the inventory that's available. And there are two things that I want to show you here. One, each of these lines are interactable. You can turn them off if you want. Because right now, condos looks flat. It's only because it's so small. If you get rid of townhouse and single family, you can see that the demand for condos, again, this is just newly constructed condos, dropped from the beginning of COVID and continued to drop through the addressing of inflation, right? So demand is down, yes, but there's more to it. Let's talk about homes for sale, inventory, right? We can see that single family dip, inventory decreased and then returned, right? Let's get rid of single family and townhouse. And now you're seeing homes for sale decrease and they're not returning back to the same scale. So what happens when you have both inventory, go down, and then shoot up a little bit, but then your demand drops like a rock? This. The scale is so different because both sides of the equation were impacting condos. Interesting, right? I find this super enlightening. I hope you do too. It is great to be able to talk to your clients using data like this in a live demonstration, like I hopefully showed you right here, right? So these were the charts, just reminders for you all of what that looks like. Um, let's talk about financing. There are two particular areas of financing I've been hearing a lot in the news recently. Let's first talk about the holistic view of it. This is the current breakdown of home financing types by year, and you can see that the conventional in this royal blue is the lion's share of financing of homes in the Twin Cities, right? It expanded up to 74% here in 2021 and has decreased slightly, but it's still the predominant norm. What has been increasing here is cash deals. Now in green here, you can see that cash deals uh, increased and have not decreased as a percentage of all sales here in the Twin Cities so far. It is 17.6, let's round up to 18% of all homes sold here in the Twin Cities so far in 2024 are done so by cash. And I can tell you, although I don't have the chart ready for you to show you visually, that it straddles many different price points. It straddles many different property types. It's an important thing to recognize that we are seeing an increase in cash deals for multiple different reasons, right? Because interest rates are increasing. Maybe in 2021, it was the investors, whether they be private or corporate investors, would rather spend money on real estate than have them be in the stock market. There are many reasons for this. But something else that has popped up on the news recently that I want to make sure that you all are seeing the difference between perception and performance is the idea of assumable mortgages, right? Those FHA, VA, USDA loans that have the very enticing low interest rate that potentially a new buyer can assume from the home seller if they currently have one of these assumable mortgages, right? There is a growing trend in Google that I found that I got this from a news article a couple of days ago that interest in assumable mortgages is going up. It is going up because people are seeing the cost of the interest rates increase and they're looking for any other way to avoid a 6+% mortgage interest rate on a 30-year mortgage, right? And the interest is there, but as that chart here showed you, the implementation is not, right? Um, the there has not been an increase in assumable mortgages, right? And we would normally see this, years past, maybe 2021, 2022, when those interest rates were at a low percent. But why weren't we seeing them, right? It's because of this, because of the enticing offer of the conventional loan, which is not assumable, being at that lowest percent. People, that is the definition of that run-on inflation. People weren't looking at other FHA options because there's so much hyper competition and there is a there's a negative connotation that I would argue is not fair to FHA, VA, and USDA loans of added uh, the added red tape that goes with it. Now I get it. I'm stats guy. I'm not a realtor. You guys have lived experience with that, and I'm not discrediting it at all, right? But there is a difference between the work put in and the perception of the work put in. And I think that's a fair assessment, right? Not saying that there isn't more, but the perception might be different, right? And we're talking about a group of people who have a need for extra support, often with FHA, VA, and USDA loans. And we're not seeing those increases. In fact, we were seeing a decrease in 2021 and 2022, and it has not increased back up to what we were seeing prior to the pandemic, even though the interest is there. All right. I'll get off my soapbox that on government mortgages and talk about the wider economy. So, like we've been talking about for a few minutes here, uh, the 30-year mortgage for the past 12 months has decreased. We are now down. It's weird to say down, but we are down from a high of almost 8% nationally on average to a national average of 3.6%. And yes, it is definitely higher than it used to be. We are back to interest rates that were set in October of 2008. It's been a while since we've been here, prior to the increase in 2022, right? Um, but we're not at that 20-year high that we were. And what does that mean for us, right? It's a messy chart, I know, but it is an insightful one. And I want to make sure I was showing you the nitty-gritty details and not just a smoothed out version of this graph, because the devil in the details is important. It helps you and your clients capitalize on those emerging opportunities. So let's take a look at this area in particular of the chart. What's happening? It's kind of like a C-shaped pincer movement, right? These two lines, blue, the change in showings, how many people are showing up for those showings, or booking showings rather, and gray, the 30-year fixed rate mortgage average, they're inverse related. When one goes down, the other goes up. You can kind of see here this spike, right? A sudden spike in a change in showings, a lot more showings, is because there was a sudden cliff of the 30-year fixed rate mortgage back in 2023, right? And then as the increased, showings dropped off. And now we're seeing more showings increase again because we were seeing a pullback from the Federal Reserve. And only just recently did the economy correct itself, just a little bit. We realized that, yeah, interest rates didn't, at this time, given the climate that we have, they were dropping almost to below 6%, and that was too fast. People jumped on these opportunities, money got more scarce, and interest rates went back up, right? Even without the Fed doing anything. That's what the economy is supposed to be doing, self-balancing. And you're seeing a decrease in showings because of it, right? It just shows you that it's not just total government control from the Federal Reserve, that it is the government responding to the natural actions of what's happening in the economy, right? Because at the end of the day, this is the only thing that they have control over. This is the Consumer Price Index. The Consumer Price Index is the thing that the Federal Reserve is most concerned about. Is this red line going too high above zero, the solid horizontal line here? Ideally, they want to get to 2.5% Consumer Price Index growth, and they have finally achieved that, which is why you may have heard in the news that they decided to reduce their effective savings rate. And so therefore, there's more of an incentive for money to go back out into the economy. And that has had an impact on shelter, us, home sales. Shelter also includes rents, right? It's here in purple, but you can see the consumer price index on shelter, which includes home ownership and home sales, right? Has gone down. We've been affecting that, right? Because that purple line is about, I think, 30 to 40% of what contributes to that red line, right? And when there is a higher increase in consumer price index, you can see very fittingly, it's for shelter here, it's at about 5%. That's higher than what it was, September of 2020, 2021, that sort of time. And if you take all of that and you put it into the context of principal, interest, taxes, and insurance, PITI, you can see that there has been a sharp increase, some seasonality in there, but an increase that happened in 2022 to 2023. And only now, for let's say the past year, we've been starting to waver back and forth. And yes, I am showing you a chart right now that does say that the median earning family paying for the median priced home, they pay about $2,600 a month with some assumptions here at the top. That is up almost $1,000 from $1,800 dollars a month in PITI payments in, let's say, July of 2021, and definitely higher than it was pre-pandemic, right? But it's all about context setting, right? Another chart that I have shown you in the past is this monthly payment as a percentage of family income, and we're still below 30%, even with this high that we are seeing here. Now, only a few more charts left. I know we only have 10 minutes to go. Estimated home price performance here forecasted from HPES at the end of last year. We saw that they were expecting 2024 to end the year out with just over 2% increase in home price performance nationwide. And they're about spot on. And there's reason to believe that they will continue to be fairly accurate with this as we wean ourselves off of the effects of the Federal Reserve in future years. We will continue to return to that historically normal home price performance increase. Here in the Twin Cities, that looks closer to 5 to 6%. Nationally, 4% seems about fair. So, a final takeaway for you all in terms of the economy for your buyers and sellers. For buyers, it's payments versus prices, right? Because as we just saw, yeah, there was a payment spike, but it flattened out and we are at a relative lull, right? And prices will return to that 6.5 average. The question is when? And do you want to make that financial decision to capitalize on an investment now before those prices return? For sellers, there really is, it's two questions in order. One, are you married to that rate versus the discomfort you have with the house or the desire to want to sell, move to a different place, whatever it is? Are you married to that rate that much that you're willing to make sacrifices like that? And if you aren't, are you ready to put yourself in the mindset of the buyer? Look to the left column, right? Because those are the important factors that your seller should be thinking of, right? So that's what I have here for you on the economy. I found something very last minute that I couldn't help but throw it in at the end. And I don't have much to tell you about this because I'm still learning it myself. But it's coming from the National Federation of Independent Businesses. If you're more familiar with it than I am, by all means, throw it in the chat. I'm going to be exploring more of this as we go in because all of you are small business owners. This should be important to you because it's giving you an understanding. This full report is giving you an understanding of your perspective versus the holistic perspective of small businesses nationwide. And one thing I found pretty intuitive that I thought would be interesting to talk about is the optimism index. Uh, this is 10 survey indicators that roughly give you an index of how optimistic small businesses are based off of 100 being the original survey in 1986. And you can see it has changed in time. You can see the dive down in 2008 and the return back up. And then 2017 tax break that came in and the ascension from that, right? Unfortunately, I can't break it down any smaller for you. It will give us always the full history here. But what I do find very interesting is, yes, because of the Federal Reserve's tax policy, well, not tax policy, monetary policy, there was a decrease, right? There was a reaction in the optimism of small businesses. And we've kind of sat around, let's say, low 90s ever since, right? When we're about 92-ish right now. But there are subsections of this. The optimism index is roughly divided into two things: hard optimism for job creation, openings, inventory, earnings, capital expenditures, right? Those hard optimistic values. And then the soft expectations of business conditions, expansion potential, real estate sales, expected credit conditions, and so on, right? And you can see that the optimism is different depending on these certain categories where those let's call them hard goods uh, don't have such a negative expectation in recent years as the soft goods did. And even the soft goods are starting to make a rebound, as you see here, because that difference, my initial assumption here was too big. There was an expectation that, oh, conditions for these soft goods would get way worse. And they didn't. And so they're rebounding back, right? Because we are establishing a new business norm. There's more to explore here. I'm sure there is, but we don't have time to do that. If you have any questions, by all means, put them in the chat. If you have questions that linger, take a snapshot of my email and send me an email. We're using research at mplsrealtor.com to answer any of your questions. Not only myself, but our research analyst is going to be observing that email regularly. It's the quickest way to get a response from us. Um, any questions for me? While I'm waiting on those, uh, some final reminders for you all, both live and for the recording. NAR settlement FAQs are on the website. Redefining home ownership. It is a DEI, an event put on by our DEI committee about expanding perspectives and talking about barriers to home ownership for different communities. That's on October 24th. Realtor Day of Service on November 21st with Bridge for Youth. Both of those events, as well as the website, there are links available at MAR if you're interested in registering for them. Code of Ethics deadline, just generally, please make sure you do your Code of Ethics by December 31st. And a final note here, personally from me, I am going to be on PTO on December 19th. So I will not be available to give you all a market webinar. We made that decision because we're out of David. He's at MNR and we don't have anyone to cover for me, which is both a blessing and for me logistically, meaning that we don't have a webinar on December 19th. I hope you all can forgive me for that. But this has been great. We are going to have our webinar in November. The exact date escapes me right now, but I will send anyone who attended or registered for this event a link to sign up for that November webinar. And I don't see any questions, so I will leave it there. Thank you all very much for attending, and I will see you in November. Bye, everybody.